Hello everyone, for those who are new to our channel, I'm Guan from AllQuant, and for those who already knew me, great to see you back again. Now today I'm going to talk about another major asset class, Forex. Some call it FX, some call it foreign exchange, some other people call it currency trading. But whatever name they call it by, they're essentially referring to the same thing. Now, the bulk of the people who trade in FX are largely institutional players. But having said that, it is also a very popular asset class among retail traders. So what I'm going to do today is I'll be giving a brief introduction to Forex by covering a few simple questions, just like how I did for all my previous videos. So the first question is going to be, what is Forex? Followed by, what are FX pairs and currency pairs? Who trades Forex? What are the benefits of trading Forex? What are the risks involved when you trade in Forex? And finally, how do you go about trading Forex? Alright, so without further ado, let's dive in. First question, what is Forex? Now, Forex represents the foreign exchange market. In fact, in all likelihood, you already have done some FX trades before, but maybe you're not aware of it. So for example, when you go for overseas vacation, what is one of the things you would definitely do? You would definitely visit a money changer, right? And over there, you're going to exchange your home currency for the currency of the country you're going to visit, right? So what you're actually doing is to buy the currency of your foreign country from the money changer using your own home currency, and that is considered a Forex trade. Alright, but this is just one example of how a Forex transaction take place. Forex transaction can take place on many other avenues or platforms. So they can take place when companies pay for their foreign goods, when you pay for overseas products which you purchase online, or when you trade through the broker itself. And for those who are not aware, right, FX is actually the largest financial market in the world by size. It is way bigger than both the global stock market or the global fixed income market combined. So its size is 2.4 quadrillion. So that is 2,400 trillion, which is about 22 times the size of the global stock market and 18 times the size that of the global fixed income market. And if you think about it, it's not difficult to understand why this is so. You can have all kinds of different assets in this world, from stocks to bonds to commodities to real estate to every single product that you owned or purchased. But all of this, right, has to be bought and sold in currencies. Right, so FX kind of encompasses all of them. All right. And in terms of trading volume, FX is also firmly at the top. So according to like various internet sources, the average daily trading volume of FX is about 6.6 trillion a day. That is 25 times, right, the value of the securities traded in both New York Stock Exchange and Nasdaq added together. And it is also 7 times the daily average volume of the global fixed income markets. Unlike stocks, FX are not exchange traded products. They're what we call over-the-counter or OTC products, just like bonds itself. So they hold a certain level of counterparty risk. And they are traded electronically through an extensive network of dealers, banks, and non-bank institutions. In fact, the process is so seamless, you probably won't feel much of a difference between trading FX or an exchange-traded product such as stocks. Now, the FX markets can be segregated into a few different types. Well, the first one is what we call the spot FX markets. Now, as the name implies, what it means is that the exchange transaction is done and completed on the spot. So that's why it's called the spot FX. So when you do a trade, right, with an FX broker, that is usually a spot FX trade. And similarly, when you go to a money exchange to exchange currency, you also exchange it on the spot. So that is also considered spot FX. Now, FX also have futures market, and these are exchange traded products. The more actively traded FX futures include your Euro futures, your GBP futures, your Aussie dollar futures, as well as your Japanese yen futures. And retail can also trade these products. As for the other two markets, which is the FX forwards and the swap markets, both are OTC markets. So they involve contracts between specific counterparties, and both markets are large. And the swap market is the largest market among all the four here, but I'm not going to talk about them here because these markets are mainly the playground for institutional players. And the size involved, right, for all these trades are usually very large and in the order of many millions. So for retail traders, right, your trade will mostly be in the spot FX market. And this is what I will talk about in this video. Next question, what are FX pairs or currency pairs? Now, when you trade FX, you will see quoted prices just like stocks. But for stocks, the quote is for a single stock. And for currencies, that single quote is for a pair. Well, because FX are always quoted in one currency relative to another. That is why that is called foreign exchange, right? To exchange one currency, you need another currency. And because of this, people who are new to FX can find it hard to interpret these quotes. And when I look at them in the past myself, I always got confused. Okay? So, but not to worry, after a while, you will get used to it. So first, let's familiarize ourselves with some examples. So over here, we have a quote on USD SGD. I'm Singapore, so I just use this for convenience. Okay. Now, the first currency is what we call the base currency, which is US dollar or USD. And the second currency is your Sing dollar or SGD. And this is what we call the quote currency. Alright, this quote is basically telling you how much of the quote currency you're going to need to exchange for 1 unit of the base currency. So the base currency is always with reference to 1 unit. And in this case, what I'm going to need is I will need to pay 1.43025 Sing dollar to get 1 US dollar. Alright, so here is another example of an FX quote on the euro dollar showing you a value of 0.8729. And over here, the base currency is euro, and USD has now become the quote currency. So what this quote is telling me is how much USD I will need to exchange for 1 euro. And in this quote, I will need 0.9729 US dollar to get 1 euro. And in the FX space, traders tend to quote FX movement in terms of pips. So you might have heard of it before. So what exactly is a pip? Now, a pip is the smallest unit of movement in FX. And in the past, many FX pairs are quoted up to the 4th decimal place. So a pip is a 1-point movement in the 4th decimal place. And even though FX can now be quoted up to the 5th decimal place, the 4th still represents the pip today. Okay, so using this example, well, 1 point here in this particular place, or the 4th decimal place, is a pip, right? So this is 2 pips, and over here on the 5th decimal place, this represents half a pip or 0.5 pip. And if we move over to the left, well, a change in a point, right, in this digit here will represent 10 pips, and over here in this digit will represent 100 pips, so on and so forth. But not all FX pairs are quoted up to the 4th decimal place or more. There are exceptions, and one of them is your dollar yen, right? And for dollar yen, the pip represents a point in the 2nd decimal. So this 4 here represents 4 pips, and this 8 here represents 0.8 pips, and this 6 here represents 60 pips, right? So on and so forth. With FX, right, because they're traded in pairs, when you enter into position, you're automatically long one and short the other. So in this case here, right, for this particular example of euro dollar, if you are long this FX pair, what it means is that you are long the euro and short the dollar. Similarly, if you're on the opposite end of the trade, that means you short this particular FX pair, then you are essentially shorting euro and going long on the dollar. Over here, we have the 10 most actively traded currency pairs in the spot FX markets. So what we have sitting at the top is euro dollar, which is followed by dollar yen, followed by the pound dollar, Aussie dollar, so on and so forth. Okay, so if you notice in all these pairs here, right, what is the currency that keeps appearing? Right, it is USD, isn't it? So out of all these 10 pairs, USD appear in 9 of them. So now can you see why USD is the most heavily traded currency? Who trades FX? Now, the first group are the directional traders. So these are people who places bet on whether a particular currency will strengthen or weaken against another. And most retail traders are in this particular group. But having said that, funds and prop trading firms also take on such bets. Then the second group are the hedgers and market makers. So this group is not so much into taking directional risks. So hedgers, for example, just want to manage the risk of the FX exposure. So they could be the corporate company who, let's say, makes money in a foreign currency and then wants to hedge out the risk in its FX movement to lock in their profits. Market makers, on the other hand, just want to make money off the bid-ask spread, right, by providing liquidity to the market itself. The third group of investors are those that put on carry trades. And what is a carry trade? It is basically a trade where you buy the currency with the higher interest rate and then you short the currency with the lower interest rate. And this difference between the two interest rates is what we call the carry. And when you maintain the position in this currency pair, you will technically be earning the interest rate differential between them. So a very popular carry trade right now is the dollar yen trade because US dollar or the US interest rate went much higher than Japan. Right, but of course, this is on condition that the FX pair, right, stays relatively stable and USD don't depreciate too much against the yen itself. right? So the risk here is that there can be a major shift in the central bank policies, which can then cause this carry trade to unwind rapidly, and it can then wipe out more than the carry you earn. But the last group I need to mention here is the central banks. So they are the largest traders when it comes to currency. But for their case, they don't trade FX for the purpose of making money. Well, they only intervene in the FX market to manage financial stability and to maintain the competitiveness of the economy. Now, it is not uncommon for countries to intervene, right, to prop up the currency in order to prevent, say, excessive devaluation. For example, the Bank of Japan just did that this year, as US and other countries worldwide have increased their rates while their own have stayed put. And this results in a widening interest rate differential which pressures down on the yen. So as a result of that, the Bank of Japan got stepped in to push up the currency against the rest, right, to support the currency. And as another example, the monetary of Singapore this year have also propped up the Sing dollar several times to fight against inflation, right, to make imports more affordable, right, for the people. And then sometimes countries may also weaken their own currency in order to make exports more competitive. So these are some examples of why central banks will intervene in the FX markets. Why trade Forex? Now, Forex is naturally built for both longs and short. And if you recall, I mentioned this earlier. So when you enter into a position within a currency pair, you're actually already both long and short at the same time. So there is no need for you to pre-borrow the currency in order to initiate a position. Next, FX trades round the clock 5 days a week. And actually it still trades over the weekend, but those are for institutions. For retail traders, it is 5 days, your Monday to Friday. But that's enough for you to trade from virtually anywhere, anytime. Then it is also the largest and most liquid market in the world. So if you're trading the major currency pairs, you can expect a very competitive and narrow bid-ask spread. And most FX brokers charge you only the bid-ask spread and no commissions. And even if they do charge you commissions, they tend to be very low. So overall, transaction cost tends to be low for FX trades. And FX, unlike your other asset class that uses high levels of leverage. So in trades in various lot sizes, there are nano lots, there are micro lots, there are mini lots, all the way up to a standard lot. So a standard lot is 100,000 units of a currency. But because of the leverage extended to you, you do not need to pay it up in full, right? So depending on the broker that you are with, the leverage can be 50 times, 100 times, or 200 times or more, right? Depending on who the broker is. So if it is 200 times, then what you need to put up is only 0.5% of the position size. So that helps to amplify returns. But of course, you need to recognize that this is also a double-edged sword, as it can also make your losses larger. And as to why the leverage is so high, that is because FX daily movements tend to be much milder as compared to other asset classes. What are the risks involved when you trade in FX? Now, FX trades can be highly leveraged when you choose to do so. And in those cases, then you can run into large losses when there are big FX moves. And even though I did say that FX tend to move more mildly when compared to other asset classes, there are still events that can actually trigger huge moves in FX. Okay, and that can happen when central banks make an unexpected policy decision, for example. And one very good example is on the 15th of January 2015. That was the day where the Swiss National Bank abolished its currency peg to euro, right? In a very sudden move that no one expects. And that resulted in a euro Swiss franc, right, crashing 20%, right, in a few minutes. So a lot of traders and even the brokers themselves are wiped out in that particular incident itself. Okay. Now, FX also have exposure to risk in various macro factors, and the most obvious one is interest rate, right? Higher interest rates tend to be associated with a stronger currency and vice versa, right? And there are also other factors such as that political stability, the level of inflation, as well as the strength of the economy and more. Alright, we're now down to the final question, how to start trading in FX. Okay, the process is very straightforward. You just go about choosing a reputable FX broker that is registered with a strong regulatory authority. Alright, then open an FX account. Okay, most of these accounts or most of these brokers will offer you demo accounts which you can use to test out your trades and familiarize yourself with both the asset class and the system first before you start. Then after that, fund the account and basically you're good to go. Alright, I've come to the end for this video and I hope all of you got something out of it. Now, if you think these videos are helpful, do let us know by hitting on the like button below, share it with your friends, and then subscribe to our channel for more updates if you have not done so. Right? And do drop us a comment if you have any feedback. And for info at AllQuant, we also conduct a range of courses on investing. If you're interested, you can pop by our website for more details. And the link to the website is also in the YouTube description below. Okay, best of luck to all of you, and let's meet again in the next video.